Losing money in your IRAs and 401ks when the market is down is never a fun experience and even scary for many people. But acting out of fear during a bear market, more often than not, results in costly mistakes. In this video, I will share some important investment concepts that I think you'll find helpful. Welcome to the Financial Fast Lane. My name is Lane Martinson. I am a financial planner and an investment advisor. Now, the stock market is down about 19% year to date at the time of this recording. A drop of 20% or more is the official definition of a bear market. So why is the bear and the bull used to describe market conditions? Just as an interesting side note, it has to do with the way they attack. When a bear attacks, it claws down. And so if the market is trending downward, then it is a bearish market. When a bull attacks, it charges and then flips its horns up. And so if the market is trending upward, it is called a bullish market. Now, historically speaking, how many times has the market recovered from a bear market? And the answer is 100% of the time. So let's take a look at a couple of examples. During 2000 to 2002, between the dot-com crash followed by the September 11th terror attack, the S&P 500 fell a full 49%. A few years later, it had fully recovered. During the 2008 financial crisis, the S&P 500 dropped a whopping 56%. And as painful as that was, after some time, it too fully recovered. Time and your specific time horizon are key factors. Now, I was teaching my University of Holistic Retirement Planning class at the University of Arizona recently. When we got onto the subject of stock market investing, one of the students said, "The stock market is no different than gambling in Las Vegas." And I said, I see investing in the stock market as the opposite of gambling in Vegas. So mathematically, the odds are against you when you gamble. Most people lose, and if you keep gambling over time, you increase the certainty that you will lose money. On the other hand, when you invest in stocks, you become a shareholder or a partial owner of a company or companies that have products or services that can generate business revenue and profits. Now, assuming you have a diversified portfolio, mathematically, the odds of success are in your favor. Statistically speaking, and based on the S&P 500 index, on a given day, you have only a 53% chance that your investments will be up and a 47% chance that they will be down. That's basically a flip of a coin. If you extend that to a time frame of just 1 year, statistically, you will have a 75% chance that your investments will be up. If you extend that to 5 years, the odds that your investments will have increased is about 85%. Over a 10-year time frame, 95% of the time, the S&P 500 has a positive outcome. And over a 20-year time frame, there has never been a time when the S&P 500 has not experienced growth. Now, past performance cannot be used to predict the future, but it is important to maintain a long-term view with investments. When you have the appropriate amount of risk for your situation and your time horizon, there is no need to be worried about every gyration of the market. The market has never and will never go straight up. It always comes in a series of ups and downs, with a long-term trend that has been always upward. Now, when you're getting close to retirement age, or maybe you have already retired, then other elements and risks come into play, such as sequence risk, for example. So everyone needs their own personalized investment strategy. Of course, diversification is important, but a truly diversified portfolio will consist of more than just stocks and bonds. When building your portfolio, it may be helpful to think of it as building your financial house. If you are nearing retirement, you should have a firm foundation that includes principal protection guarantees. Typically, guarantees come from an A-rated insurance company. Fixed index strategies that not only protect against market losses, but can also grow productively with the use of stock options and the performance of a market index. Now, the walls of your home could consist of alternative investments, such as actual real estate or REITs, real estate investment trusts, that you can invest in right within your funds of your retirement accounts. Also, DSTs, or Delaware Statutory Trusts, is another way to hold real estate without the need of personally buying an investment property. Also, structured notes can be an excellent alternative investments within the walls of your portfolio, as well as certainly commodities. And then the roof of your house would be the stock market. Again, over time, stocks have always trended upward and have been a great hedge against inflation. There is no need to fear when you know that what your time frame is and you have a well-diversified portfolio. I invite you to visit thefinancialfastlane.com for some free resources and for more information. If you found this video helpful, I would love to know. I welcome your comments below and hope that you can give us a thumbs up and share this video with someone else that may find it beneficial. So thank you very much, and I look forward to seeing you in the next episode of The Financial Fast Lane.